Are we on?
Oh, I think we're actually on.
No, not Fear Factor.
Oh,
it was a hidden camera show on like FX, and like they did alien stuff and like really freak people out.
Was it
Fear something?
Who is? So it wasn't actually Fear Factor. It was Aldi Fear Factor.
Yeah, it was something like that. Scare tactics.
All right.
Holy cow, guys! People almost died.
Anyway, what a great insurance idea. So, all right. So we're going to TMI on PMI. I can't even say it. TMI on PMI today. PMI, the swear word in church. Everyone's afraid of it. Boom. Yeah. Hey, we'll start off with this. If you're over 55, just click off. You guys have this horrible opinion of private mortgage insurance. I get it.
Those are the people that are paying off their houses on purpose.
Yeah. What are you nuts? You trying to put us out of business over here? All right. Enough of the jokes. PMI, private mortgage insurance. This is not the insurance that you contact Adam's office for.
No, I don't sell this.
No one really actually sells it. There's like 6 or 7 companies that mortgage companies and Fannie Mae and Freddie Mac partner with to provide this.
I got a bone to pick with PMI. I'm just letting you know.
All right, let's hear about it.
Well, I just don't understand it. Help me.
Me either. I click a button and it tells me number.
Yeah, well, why do we need it?
All right, so PMI exists on conventional mortgages where your loan to value ratio is above 80%.
Okay, so you don't have 20% equity.
Correct. So you're not putting 20% down. You're going to have PMI on a conventional mortgage. Okay. What does it do? It protects the people who buy Fannie Mae and Freddie Mac securities in case of a loss. So the loss being a foreclosure.
So it saved us in 2008.
It saved nobody.
I was going to say, I'm like,
what is the purpose of it?
Bad example.
Yeah.
Bad example.
Excluding like the 2008, 2009 financial crisis.
Forget about the time that it was most needed.
That is actually
what we bought it for? Where was it?
That's what happens. And we'll go through what happens through all of this. But what it does is it protects the investors and or the aggregators, the banks, whomever is purchasing those securities against a potential loss situation. So when a property, Tony, you could probably chime in on this part, properties go into foreclosure, right? A asset manager or someone is going to take over the disposition of that property, right?
Correct.
So one of the things that happens a lot of time, property, okay, it's foreclosure, it goes to sheriff's sale. What happens at sheriff's sale? Well, the bank shows up. In this case, there's PMI. The PMI company might show up, and then the general public show up and they bid on this property. Hey, we're going to buy it for whatever, 150,000. Well, does 150,000 wipe out the unpaid loan balance? That's the question. Well, that's what PMI is there for. In the case that it doesn't cover, the bid or the disposition of the property doesn't cover the unpaid balance of the loan, plus the accrued interest, plus the administrative cost of the foreclosure, then that servicer or the aggregator, the investor in that bond, however that loan is securitized, would receive a percentage of the loss from an insurance company.
Percentage of the loss.
Correct. So like a lot of times, like if a mortgage guy might go like me, may go too far into the weeds on occasion, and they'll pull up a chart and you'll see the PMI coverages are a percentage. And Tony, we were talking about this before. You would see like a percentage number, 35, 25, 12.
So in your example, 150 grand, but the nut was 200. So we got a $50,000 gap.
Yep.
The PMI is like, we'll give you half that, bud.
Pretty much. Well, actually, less.
Not even.
They're going to give you
12%, 35, or
yeah. So we'll give you a quarter.
20.
We'll give you 10,000. Sorry.
Yeah.
Yeah.
So all it really does, in my mind, hearing this, because I really didn't understand it, I kind of had an idea, is that it probably makes those loans, when they package them up and sell them off, it makes them a little bit more like desirable from the risk standpoint. Because, we've got PMI on this. I know it's not loan to value at 8%, but we got PMI, so buy this.
It is the perfect route for risk transfer because I'm charging you to protect myself.
Yes.
Tony, what are you going to say?
So yeah, I was going to say, well, I mean, you'll get this being in insurance. Actuaries who basically inform underwriting practices. So the nerdy guys who look at what's the level of risk. Dudes. Yeah. They realize that, okay, there's this criteria that will make a loan good, borrower criteria. But once we get beyond this, it's too much risk than what we're willing to tolerate. So what mortgage insurance does is it basically comes in and says, well, hey, if you go a little bit further on those, push them a little bit further, we'll give you some insurance
We'll
on
come
it.
back down. We're going to
All
bring
right?
that risk level. a little
So
bit.
it opens up some financing options that wouldn't exist to people who wouldn't have any other options without it, which is basically actually the same thing. When we talk about FHA and VA, people don't realize that FHA and VA, that's really just government mortgage insurance on a loan. And it's just a different way as how they package it. So I think one of the reasons, and so many people don't have
our next episode, we'll go through FHA, VA, and USDA because it's similar, but also a little bit different.
Yeah, but as a whole,
Yeah.
the idea is those loans wouldn't be there unless there was some form of insurance, whether
Correct.
it's the government picking up the tab or private industry, which is why PMI is called PMI. The P stands for private mortgage insurance. All right. Right. Okay.
Yep.
So we have so many people down. I think one of the reasons we wanted to talk about this today is it seems like business today is striated into two categories of borrowers. We're either seeing people who have a lot of money down, they're putting down like 50, 60%, or people who have very limited funds and not a lot in between. The other thing that we see historically is people avoid and put off even calling us or buying a house because they know that they don't have 20% down, and they've been scared their whole lives by some boogeyman in the room called PMI, and it's this terrible thing, and if you have it, it's going to be god-awful expensive, so you got to wait till you got 20% down. That's not necessarily true, right?
Correct.
So if I have PMI, is it a set dollar amount per dollar amount? How does that work?
So let's talk about that because there's three ways on a conventional mortgage that PMI can work. All right. You can have monthly PMI. So you're just paying this, it's built into your mortgage payment, X amount of dollars. And we'll talk about how that factor works. You can have single premium MI. So you can pay a flat dollar amount at closing and not have monthly PMI. It's just one number, done. How that number comes about, again, similar to, and we'll go through the calculation on it, but some risk and loan to value stuff. The third option, which is actually picking up a lot of traction, is split premium. So you pay a portion up front to then have a very reduced monthly number.
Pause there. One nice thing that we can do there with that is, depending upon where we're at negotiating for you, sometimes we can negotiate a credit and actually have the seller pick that up, which is why the split premium thing is pretty nice. If we were to ask the seller to pick up the whole front loaded side, maybe a bit much, but something like that's not going to be that much. We can oftentimes factor that in, get that covered for you.
How long does it last?
So that's a fantastic question. So if you engage in the monthly or the split, all right, you are going to have PMI, monthly payment on there until you get to 78% loan to value or 22% equity.
Okay.
That is when it automatically cancels. Okay.
How does it know?
When you'll sign a disclosure at closing that says, here's your PMI. Here's when you can request PMI cancellation, which is at 80% loan to value. Here's when it automatically terminates. So you're going to have an amortization schedule.
Okay.
All right. Now, if you pay more money per month, you hit that level faster.
So they're locking in the value of your property at a fixed amount and saying, once it gets to here, but you can say, hey, hold on a second. I think I've had some appreciation.
You can.
Okay.
So this is going to be a really tricky and slippery part because there's a weird caveat in Fannie Mae and Freddie Mac's requirements that say that in order to request PMI cancellation on the sole basis of property appreciation, you have to have made your last 12 mortgage payments on time.
Well, that makes sense.
Yeah, except for when you buy the house and then 6 months later you think it appreciates a ton.
Oh.
The only area where that becomes sticky is if you're at like 83 or 84% loan to value or something, right? And you can make up for that. However, I'll say what I want to get into just briefly on what the payments are and how they're structured is what you find out is that it's not this one number and either you have it or you don't on your payment. When we get to, it's broken in 5% LTV, right? So 80 to 85, 85 to 90, 90 to,
just like those,
right? So when we're in that first level, right, it's not going to be it's not going to cost that much where it's even going to be worth your headache. You may as well just keep making your payments and let it fall off.
Here's a crazy part, and we've talked about this, and people have seen this loan level price adjustment matrix floating around a while back about your loan to values and your FICOs and how Fannie and Freddie charge a lender to deliver a loan. A lot of times, if you have pretty strong credit and you're in that 80.001 to 85% loan to value basket, it'll be cheaper to take PMI. You'll get a better interest rate in that window because, again, the surety of a payment of a loss incentivizes credit risk transfer, right?
And you keep a little cash in your pocket.
Exactly. It's a weird, you want to call it a hack? I'm sure it'll probably
call that an arbitrage situation.
There you go. I mean, it's a great thing to think about, but like if I give you a 0.25% lower rate, it's only going to cost you $11 a month in PMI that you're only going to have for 2 years, you're going to win.
Yeah. So it's obviously loan to value has some relationship to it. Now, does your credit score impact that as well?
Yes, huge. So the biggest components of PMI cost, a combination of loan to value and credit score.
Okay.
So you take those two things, those are the two primary drivers. The next driver is going to be property type. So single family PUD, like single family detached PUD, those are all
PUD.
Yeah, PUDs.
That's planned unit development.
So those are all going to fall into the neutral category. When you get into manufactured housing and condo, you're going to pay a little bit higher of a premium on PMI there too.
Okay. So how is it broken up? I remember back in the day that we used to get these matrices to figure out what rate would be. And it would start at 80. So 80 to 85, 85 to 90. And then beyond 90, things kind of escalate, but it can go 90 to 95, 90 to.
So it's 90 to 95. And then there's also 95 to 97 for people who have income in the under 80% area median income, or for buyers that are first-time buyers whose income exceeds area median income, but they qualify for one of Fannie or Freddie's high LTV first-time buyer products.
Okay.
So that 35% coverage, which is on the 95.01 to 97 on the non-home ready, home possible, so the non-area median income ones, it's pretty expensive. And at that point, we're probably having a conversation about what makes more sense, FHA or conventional at that point.
So pause right there. So that's actually a conversation that I have with buyers often, is I'll have people with like 15% down and like, they're afraid about the PMI. I'm like, you and good credit, like your PMI is going to be like next to nothing. I'm like, actually, you can even push it up to 90. So like down to 10% down before you start to get a big hit. You get a fair amount of a jump after 90 to 95, but beyond 95, things start to get pretty expensive. And that's when you really need to start thinking, is an FHA mortgage better, or is something else better, or should I really wait?
Yeah. And so let's talk. I actually have a quote up for a mutual client of all of us right now.
Okay.
Hopefully she's not watching here, but this is a 95% loan to value. Okay. So 346,000. Yeah. 346,000 purchase price, putting 5% down, and I think she had a 725 credit score. All right. So you can see things that matter are things that they're going to care about. Like we talk about property type, occupancy, credit score, DTI, like those are going to be the drivers into the factor. But this, right, we talk about relative cost.
Okay.
$120 a month. So 120.52 a month on a $328,700 $328,700 loan.
What's the
Not
amount?
bad.
What's the amount?
120.52 a month.
I think I spend that in Zins per month.
I think that shows up on my front porch every other day.
Exactly. Or I mean, think about it, or just if you have 3 credit cards at $50 a month minimum payments, it's $150 a month right there. Like that's a pretty favorable amount, right? So your cost annually on there is $1,446.
It's just a tax. It's just a tax if you're
So actually, to pause right there really quick, getting back to like the consultation with you, which is what I kind of push a lot of people to, and they start telling me what's going on. This is an area where the consultation is important, because here, if you meet with Tony and you have some credit card debt, but you want to buy a house, you're trying to save your down payment, there's some instances where it may actually make sense for you to say, okay, put less down on the house, pay down those credit cards, take a little bit of mortgage insurance, your overall savings and household budget's going to be improved.
Yeah.
All right. So looking at this stuff from a 30,000 foot view, this is something that like we can't help you with, but like
most people,
something that you look at.
The experience, I think, lets you zoom out. Because like when people are like, I want to buy a house, they're focused on, well, what's my payment? And
Right.
Tony's like, Well, your payment is actually all these payments because we're talking about your debt as a whole. So let's zoom out. Let's see if there's other debt that could be shifted around. Like that's what experience gives you.
In this particular case, so this lady, the $120 a month right here is actually saving her $859 a month in outflows. So
Wow.
she's $700 a month ahead, real dollar, like net dollars. We're not talking about gross dollars that are getting taxed and whittled away. We're talking about in the bank money. And she couldn't see it. She couldn't see it. She didn't like people. Life happens.
Yeah.
You know, you get thrown a curveball. You got to make a decision. Well, let's look at the opportunity where you're going to realize the most capital you're ever going to realize, the sale of a house to clean up all your problems, right? All the bad debt, and get you back into the market at a house that you like in a much better, right? What if I told you that I could put an extra $800 a month in your bank account every month?
Yeah.
Like, who's not taking that?
I mean, I'm taking it. Well, what do I got to do for you?
Smile.
Yeah, no, absolutely. So this gets to really why we want to discuss this is we see people holding off because they're coming up with these ideas in their head that mortgage insurance is this nasty thing, and that if they have it, it's going to be crazy expensive, and they have to wait until they have 20% down, or they have to wait until they have more down. And it's like, stop, hold the horses, have a full analysis of what you have going on done by Tony, and let's walk through some of these things. We could actually learn that through buying the house and doing this, we're going to actually cut down some expenses for you. Let's get to the sixes.
Oh yeah,
I see. I see we've got a nice chart up here.
Yeah,
now.
a lot of sixes on this. So like, let's talk about what it actually takes to save
Frightening
your
amount
20.
of savings.
A 20% down situation, right? So we have a borrower that makes $74,000 gross annual income, right?
Okay.
We'll call it a salary. That pretty much equates out to about $4,400 a month in net income after taxes if they live in Lake County, Indiana.
Okay.
Right? This factors in no 401k contribution, but health insurance at about $450 a month. All right. Now you have your living expenses, rent $1,500, probably a little bit low. Car $500, probably a little low. Groceries $500. Single person, you could probably live on that. Miscellaneous expenses $235, probably an understatement. But let's just say perfect world so we can get to the level of sixes here.
Okay.
So that leaves you the opportunity to put $1,666 a month in savings each month, right?
Mm-hmm.
Annualize out $19,900. All right.
20 grand.
Yeah, 20 grand, right? So let's go back into we'll skip over this one. Go back into our $346,000 purchase, right?
Okay.
In order for you to save $80,000 or $70,000, it's going to take you 3.5 to 4 years to do that.
And that would be 20% down.
Yes.
With 100% discipline, which is not like
correct. Yeah. And probably an understatement on those expenses to begin with.
Super disciplined for 4 years, living like a pauper.
I couldn't even be disciplined for 4 hours. Like,
all right.
Okay.
All right. So you take your factor in, right? Reasonable guess on appreciation, 3%, 2%, 2% over the next 4 years.
Yeah, that's super conservative. So that's real safe.
So that $346,000 house in year 4, when you finally have your 20% down payment, is probably $370,000.
Okay.
In that same equation, right? You go, that lady who bought the house at 346, she owes at the start of year 4, she owes 317 on that house. If you go wait until year 4 to get into this, you're starting out with a $296,000 loan, but you've also, the best way to explain it, you've pissed away $54,000 in rent during that entire period.
Yeah.
And then all the other appreciation. So you've missed out on $30,000 of appreciation. You're missing out on opportunity for amortization. And then we're trusting that you've done this discipline for 48 months in a row. And life didn't life during that process. So what if we could do this, right? And your cost here for 5% down versus 20% down is $1,500 a month or $1,500 a year. So $4,500 puts you into that house, apples to apples there.
Oh, Tony.
I don't know what just happened, but I'm pretty sure we just saved some money by buying the house now as opposed to waiting. That's really what it comes down to, right? I mean, and we see people where it's like, okay, yeah, like you just don't have it together, or you have 2% down. We're trying to make it to 3. We're really squeezing. Like a lot of those people, it's like, look, you should just pause, right?
Yeah, there's nothing.
But if
wrong with
we're
it.
near, you got some money down, a lot of times we find, hey, you've got great credit. The mortgage insurance really isn't that much. You'd be better to take advantage of the market now, get into something, right? Maybe take some of that extra money that you have, pay off a credit card debt, right? And put a little bit more on your loan here, get into a house, stabilize your life, and get a real solid plan going right today, right? That's kind of like the nexus of it.
Yeah, that's part one. Part two, I mean, we've all had conversations about this. All these people that want to buy houses on 5 or 10 acres and you want to put up a Morton building or you want to put up a building, right? Well, let's not burn all of our cash into a down payment. Let's preserve our cash because it's going to be way easier for you to finance more on your house and pay cash for that building.
Absolutely.
Those buildings aren't cheap either.
Exactly. So like,
Thinking.
what if we flipped it around, right? And took that entire
I
equation.
need 150% loan.
Yeah.
You got MI for
Yeah.
that?
I used to call Long Beach Mortgage. They probably got that for you.
Well, if you say, I promise I'll pay.
Yeah, of course. Just promise. Are your fingers crossed?
Yeah, you can do it.
But if you think about it, right? So in that equation, let's go $120 a month. Is that Morton building worth it then? Probably. How else are you gonna get it? Like that's the strategy. But we can't get to the strategy if you're not talking to Tony, you're not talking to me, you're not talking to Adam.
Right. So mortgage insurance isn't this big, scary thing. It may be real expensive for you and you may not want to decide to proceed. But like I'm blown away at a lot of things where like, they're putting down some money and it's really not that bad. It accomplishes your objectives, gets you in the house, can clean up your overall finances and allows you to take advantage of some of that appreciation moving forward. Interest tax deduction, which is that going by the wayside? I don't think they'll ever get rid of that. It's limited.
It's limited. Well, and then
capped
also
at 12,000.
Yeah,
10,000?
and then the other part is your standard deduction is so high now that a lot of times you're not even going to hit the interest in real estate tax benefit anymore. So like a lot of times, a long time ago, we used to say PMI. We would do one where we build it into your interest rate.
Right.
We call it the tax buster
Yeah.
because PMI wasn't tax deductible,
Right.
but interest was. But I think that was when the single person standard deduction was like $6,500, and now it's 14 or 18,000. So yeah, some of that strategy has gone away, but we can't get to any of strategies if you're not willing to have the conversation. We can talk about it. It doesn't have to be for you.
And if you have, especially if you have good credit, the rates of what you're going to pay and good credit and some money down, it's really not going to be that bad of a deal.
It's just a tool in the tool belt. And you don't know what tool you need because you're not the professional. Go find one.
And if you know, if you know how to use it, right, which is what these guys do, right? Here's how you use this to get to the next step.
That's it. It's one more step, right? Like you need a 7-iron to hit a ball 85 yards? Probably not.
Speaking of that, okay.
Yeah,
So
we got Masters.
We got Masters. We got who do you got? The Final Four, all number one seeds.
Yes.
Number one. Who do you got? Florida. Pretty tough.
Houston.
Duke.
Masterpiece son on Houston.
Duke's the only his masterpiece. Are they showing him in the No Limit Soldier in the stadium?
He's driving his bourbon and lax there, man.
No, I mean
Thursday for the
Final Four.
Final Four.
Friday, Saturday, and Monday, maybe.
Who do you got for the Masters though?
I don't know. Like,
Scheffler's
he's plus 350. He's plus 350. He's the favorite by far. Rory's 2. Maybe Rory pulls one off. I don't know.
Someone could sneak in there. It's gonna be magical.
John Rahm, I don't know.
This Tony has left the building.
Yeah, exactly.
Conversation.
Let me get Shane Lowry.
Matt, I'll watch Master Chef. That is an awesome.
Well, they
you
do
see
have
the
a
reels?
chef. They have a chef that cooks a dinner.
Well, hey, that'd be neat.
Let them cook.
I get to go my first time. I'm going.
Oh yeah, that's
so I leave
awesome.
Friday, Saturday.
Oh wow.
I'll be there Monday.
It's Augusta, Georgia.
Yeah.
Yeah.
So I'm gonna lay down on the grass and cry and do all those things. There's a picture over there of my grandpa playing it.
Wow.
This is gonna be really cool.
That's awesome.
That's awesome.
Out of like a golf nerd to golf nerd, that's pretty happy for you on
It's
that
the
one.
mecca. It's I don't even know how would you compare that to football or basketball. I don't even know if there is.
It's like the Super Bowl.
It's bigger than that.
Really?
It is bigger than that.
it's way less corporate. I mean, like,
Yeah.
I think what's the sandwiches are $3 and the beers are like $4 there.
Yeah, you can get hammered for like $25.
That's like Talladega.
Yeah.
It's a Talladega of golf.
Adam,
I'm on fire.
Well, if we see someone streaking across Amen Corner, it's probably Adam.
It might be me.
All right, so who do we got for basketball though? I'll roll with Houston.
I'll go Florida.
Duke.
Duke's the only team that's been covering the over, if that matters to anybody.
That probably matters to the 4 people that watch the show and the 3 people here. All right, anything else?
No.
I think we're good. Have a great week, guys.
We'll smell you guys later, as Holden likes to say.
All right.
I'm done. Cut the show.